All right, everyone. So I was told to keep it a little lighthearted, but we all know multifamily is the hottest thing right now. I was last cycle, I was in a taxi, and my taxi driver was talking about his 3 condos he just bought in Miami. And a couple weeks ago, I was in an Uber, and the Uber driver was telling me how he's buying an apartment complex. So, that's what we're all here to discuss. We have some real seasoned veterans here that have done it, have gone through from the beginning of the cycle till now, and we just wanted to kind of pick their brains, and I'll let everyone kind of introduce themselves. What I do want to introduce, I want you guys to also tell a good war story through the cycle. I'm kind of springing it on some of you. I'll give you 1 second to think about it. My war story is, my name is Aaron from FM Capital. My war story is we once took over a property in Phoenix in the summer, and it was about 125 degrees. We ended up taking back the property via deed in lieu of foreclosure, and basically the guys gave me the keys. We walk into the leasing office, and there was nothing there. He took the computers, the desks, the pens. The manager looked at me with tears in her eyes almost and said, "Can I go to Walgreens and buy a phone?" At that same time, the chiller system broke, and the tenants started rioting and actually picked up the manager's car and were trying to throw it into a dumpster. So that was my war story that I will forever remember, walking in Phoenix in 125-degree weather. But I'll let Adam kick it off.
Yeah, so actually, I had something similar where the guy who cuts my hair is going to Grant Cardone conferences and just started buying apartments too. So I guess the short on me and the company, Tzadik Management, my name's Adam. I started the company about 12 years ago. We've owned, sold, and managed close to 25,000 units in the past 12 years. Today we'll finish the year at about 10,000 units. I guess my war story, so 10, 12 years ago, I used to go on site all the time, and I used to collect rent, and I was a receiver in Liberty City here. And I remember there was this one resident that I was just after to collect rent. And so finally, I was there on a Sunday. The guy's like, "Fine, you've been very persistent. I'm going to pay." So he goes, and he took a knife, and he cut a hole in the ceiling, and he went up, and he actually took out $3,000 cash. And as he was paying me and I was walking back through his kitchen, the entire ceiling collapsed. So that's my war story.
Before I begin, I just want to thank the entire eCore team for putting on a phenomenal conference. Truly amazing. My name is David Colman, CEO and co-founder of Roco Real Estate. We own multifamily properties throughout the Midwest and Southeast of the United States. So I would say my one horror story is not specific to a property, but to our business. We started buying in 2012, utilizing third-party property management companies across the country. And at our peak, we were using 10 different management companies to manage our properties for us. And we decided, once we hit a critical mass, to bring property management in-house. And on February 29, 2016, we launched Roco Management. And in one day, we took on 15,000 apartment units, and everything, I'm telling you, everything that could have gone wrong went wrong on this day and on this transition. But fortunately, we got through it, and we moved on. But crazy day, crazy experience.
That's a good one. My name is Stuart Zook, and I am the managing principal of Monument Capital Management, based here in Miami. We've purchased since 2012 a little bit over $1 billion worth of real estate throughout the United States. I had the pleasure of being on the same property Aaron was on in Phoenix. He forgot to mention about the people who when they were having electricity problems, they were actually cooking eggs out on the sidewalk to prove how hot it was. So it was pretty crazy. But my biggest story was I used to run a company in Minneapolis, and we had a property in Owatonna, Minnesota, and it was a tax credit property. And the state of Minnesota is actually has a very large population of Somalians, and I don't know much about their culture. I still don't, but tried to learn. And I didn't realize in this small town that had a fairly significant Somalian population that they're a very warring people. They don't always get along. And you got to be really careful who you lease to, because if you have two different tribes in the same building, it can get interesting. So within 1 week of renting to two families that were from different tribes, after 15 police calls and the SWAT teams being called out, and people actually standing out there with spears and doing some really weird stuff, I kind of just decided that the tax credit business wasn't for me, so I kind of got out, but yeah.
Thanks, Stuart. I'm Michael Stein. I'm the founding principal of Pensam Capital. This is my third decade in the business. I realized I graduated college in '89, and I'm still here today. I have a little more hair than Stuart, but both of us are graying. So we have a multifaceted, vertically integrated multifamily company. We are invested in about 30,000 units in 20 states throughout the U.S. We invest in various parts of the capital stack, both as a direct equity investor, as a bridge lender, and in preferred equity and mezzanine positions. We're also building ground up in a couple states right now. My war story is sort of the opposite end of the spectrum, going from Scottsdale to Buffalo, New York. They should know that when a Miami kid is born and raised in Miami, you don't invite him to go out to Buffalo to do a deal. But I went, and we recapped a 23 property portfolio with a Buffalo developer behind 20 different lenders on properties that were under construction throughout the Northeast, New England, and the Midwest. And these properties were, call them independent living, active adult, 55 plus, but when you go up and visit the properties, everyone's definition of active adult is different. These were a lot of walkers and wheelchairs, and when you go up there and you see this demographic, and you're my age, you know, every grandmother at the table is trying to set you up on a date. So I walked away with a lot of phone numbers, and we ended up closing the deal. We put out about $23 million across this portfolio, and I haven't been back to Buffalo since, nor did I follow up on any of the phone numbers. So that's my war story.
All right, thanks a lot, guys. So I think the general question, and I'll just open it to whomever wants to jump in first, is where are you guys buying now? How are you buying? You know, why are you buying? You know, are deals that tight now? And, you know, where are you guys finding opportunities?
I'll kick it off. So
feel free to cut them off anytime.
Yeah, I start rambling.
So
in short, we've been transitioning a lot of our ownership from where we bought 5 and 10 years ago to more in the Central Standard Time Zone and the Mountain Standard Time Zone. So now we have 1,600 apartments in Sioux Falls, and that's really been a consequence of, we looked at from 2008 to 2010 what the multifamily performance was in the markets for both market rent and vacancy. We wanted to make sure that today it's financeable. And our criteria, although cap rates have gone down, our cash on cash requirement of really trying to hit 10% or more hasn't changed, which has led to why we're selling, you know, we're a net seller in Florida and Georgia, and we've been a major net buyer in the upper Midwest. So, you know, when we're looking through the bank statements and the income statements and the balance sheets and wanting to make sure it matches, and we're not just going to have the NOI that we want, but actually the distributable income, it's been very difficult for us to find anything in the primary and secondary markets.
So when you do due diligence on a property, you actually look at bank statements and financials? All right, that's good. So,
and balance sheets.
and balance sheets.
We're focused on Michigan and Ohio. We want to be extremely geographically focused for property management reasons, more so than anything else. To give you a better context, we used to own properties across 14 states, and finding deals, raising equity, securing debt were the easy things for us. What was a huge challenge for us was property management. So we want to buy properties closer to our corporate office. We want to build the best property management company in the country, and you can't outgrow your problems. So if you have problems when you own one property, it's gonna be a much bigger problem when you own 110 properties. So just really focused on Michigan and Ohio right now, and we're buying a deal in Cincinnati, Ohio. But we bought 109 properties in 5 years. When we started the company, in the last 18 months, we bought one property. So that gives you an idea that it's very challenging to find deals right now, and we have been selling rather than buying right now.
You recently traded a big portfolio.
Yes.
Why?
Yeah, so
Aside from making money.
I guess, yeah, two reasons,
You know.
right? Number one is we were very fortunate when we started buying in 2012, and just due to cap rate compression, we were able to exit and give a great return to our investors. The second part is property management, right? We thought we are doing a very good job servicing our residents, and we have very happy residents in Michigan and Ohio. But property management was a struggle in Louisiana and Alabama and Mississippi and Georgia. So we sold a big portion of our portfolio so we can better service our residents in Michigan and Ohio and perfect our property management operations. And once we do that, we will then continue to grow and obviously buy during the next recession.
So the joke in our company is Stuart will only buy properties in places where we have to change planes. We don't go to, we are still primarily and have always been a secondary and tertiary market buyer. Now that doesn't count for some of the properties we've owned in Houston and our recent concentration on purchasing properties in the Chicago area. But for the most part, that's what we've done.
Stu, you don't give your employees a private plane?
No, and Alex charges too much money for me to use. So I don't. But we do, we're spread out. We are still in 14 or maybe 15 states. And what we try to do is get as much local expertise in those markets and try to build some kind of scale where we can. We have been able to find deals, but if you asked me 5 years ago, would I be buying in Johnson City, Tennessee, and Jacksonville, North Carolina, I would say no. But yet our last two deals that we've closed have been in those markets. So our focus has been 100% on yield, and we have truly backed off on any kind of IRR dynamics, as most of our major investors are family offices, and they have no desire to even discuss IRR anymore.
And what kind of yield are you guys underwriting to?
In terms of
Cash on cash.
Cash on cash?
Annual yields.
Yeah, I mean, we're trying to stay, in year one at around an 8, and then be in double digits after that. And we've been able to do that. For the most part, that's pretty much where we are. And the other thing is, our people are asking us to hold longer.
Right.
3 to 5 and 5 to 7 isn't long enough anymore. They want us to hold, if we can, 7 to 10 years.
Got it. And then what you guys all mentioned a little bit about property management. I just wanted to put it out there of, what do you think is more efficient? What have you guys done? Third-party property management or in-house? What?
From our side, on the property management side, on properties that we own and we're the majority investor in, we bought a minority interest in one of the largest management companies in the country. So they do all of our property management across our portfolio. On the investing side, where we're not owners, but we're investing in a preferred equity or mezz position, we're generally looking for best-in-class operators in a certain market that has local market expertise. We're geographically agnostic. We'll invest from Buffalo up and down the East Coast, across the mid-Atlantic states, as far west as Denver. So as a preferred equity provider or as an investor somewhere in the capital stack, we'll go to any second or tertiary market where we can get yield.
So the third-party business, or how we manage, it depends. If you believe you can hire, it's all about people. So if you believe you can get better people than the person that's there, then you want to do it yourselves. We manage, we don't manage in Texas, but we now are managing everywhere else again. We tried outsourcing, and we found that, this whole mercenary issue still exists with third-party management. You're not going to get any super forward thinking. You're going to get screw in the light bulbs, do some basic things, but there's not going to be how do you do a value add play, an aggressive value add play. They're not going to bring anything to the table. So our type of properties are, I'm a Sam Zell disciple, so excuse me, sometimes I use too many of his terms, but we're high beta properties, which means the effort equals the return. And the third-party people don't necessarily give us the same effort as our people do. So that's why we
this is where I spend all of my time right now, so I'm very passionate about this.
Sorry.
We decided that if we wanted to build the company we wanted to build, we had to manage our own properties. And we spent a ton of time and money and resources on building our culture, on investing in our people, and on making sure that we really are taking care of our residents. So there are some great third-party management companies, there's no doubt about that, but we knew that we wanted to have a property management fully customized to our portfolio. We're not interested in doing third-party management. We just want to manage our own properties and do the best job we possibly can for our residents.
So we do third-party as well. We both own and manage and do third-party. And I think industry-wide, one of the biggest challenges has been employee turnover and employee engagement. So one of the ways that we have tried to get around that or be ahead of the market is we measure something called Net Promoter Score, where we're constantly measuring the employee's level of engagement. And the way that you measure that is through surveys and interviews where the people who would give you basically a 9 or 10 would hire their family or their friends, which a lot of people in this industry would absolutely not hire their family or their friends. And then you subtract the people that are disengaged, which is a 6 or less. And statistically, in all businesses in the US, about 30% of the employees are engaged. So if you think about it, that means that 70% of the employees in the United States either are unhappy where they're working, they're actively disengaged, meaning they're working against the company. So as a measurement, if you can get to 50% or more Net Promoter Score, you're running a company that probably has 3% employee vacancy and less than 30% turnover. And one of the best things from that is then you don't find yourself chasing leasing agents and techs, who leave for $1 or $2.
Right, we were talking about that before, that, you have people that leave for $1,000 salary and they don't even tell you, and
they leave for a small amount of money, but if they're engaged, it bypasses just the money issue, and engagement doesn't cost anything. Someone's truly bought into the company.
So in one word though, where's the hardest place to staff? What city is the hardest place to staff?
Wherever there was a hurricane. Seriously, wherever there's major construction going on, it is very difficult to staff on the maintenance side because, let's face it, guys, we are not the highest paying industry in the world. In fact, we're probably one of the lower paying industries in the world. So on the maintenance side, at least, We found that any place that, we had trouble in Houston when the storms came through in Houston. We've done some work now in North Carolina along the coast, and we're struggling a little bit in those cities because somebody can go to work, it may not be a long-term career decision, but they've decided they can go make $3 an hour more working construction instead of fixing somebody's plumbing in their apartment. So that's a real problem where there's a lot of building.
The reality is that it is a super tight labor market, and there isn't a ton of loyalty to businesses in this day and age. And it is very difficult to keep people engaged. And the best way to keep them engaged is appreciation. If an employee feels appreciated by the company they work for, they will stay at that company. But it's a challenge when you're a big company and you have a lot of properties and they're spread out. So they'll leave for $1 more an hour, or if it's a nicer property or a less commute. So just really making sure your employees feel appreciated and valued will keep them at your company. But at some point that will swing, right? Employment will pick up and there'll be less opportunities, and you'll be able to keep and attract really high quality people.
Everyone's very PC. I was expecting a city. I was going to say Birmingham, but
well, that for us was the case. But
cannot find. Everyone thinks Birmingham is like Charlotte. It's not. So
no.
We could not staff that place, but that could just be us. No, so another thing is with deals coming out and guys buying recycled deals that have gone through the system, been flipped, been value added, then value added again, then value added again, and every broker is selling every deal adds a value add. Like, how do you determine if a deal is an actual value add or if it's just, hot air? Like what?
It's hot air.
Huh?
I mean, most of them I call value subtract. I mean, they're not real value adds. It's just rates have come back down and people have to do something. But in terms of if you were to just look at the distributable cash flow at the end of the day and take IRR out of the equation, how much is the distributable money actually gone up per year? After you take into account taxes and payroll up and insurance and all those different things. And that's really the challenge.
So to break it down, if a deal is a going in 5 cap on paper, based on a BOV or an OM, what does that translate to in real cap rate?
Us not buying it.
Meaning cap rate, if NOI is a fictitious thing, right? Because CapEx everything's capitalized. So let's uncapitalize the capitalization and put everything above the line. What's the real cap rate that deals are? What's the spread between a 5 cap, what is that, a 2 cap? A 3 cap?
Everything above the line?
Yeah, what's the real money to actually distribute to investors without playing a float game with APs or over raising and distributing out? Real actual cash flow.
Probably half that.
Half that.
But so I'm extremely, and I speak on behalf of myself, not the panel, but I'm extremely bullish on multifamily real estate, right? I believe long-term in the business, and no shot at Jordan's story yesterday about the Rodney Dangerfield, but I love that we have a room of super active, interested, multifamily professionals, and the demographics, the trends, the short supply of multifamily. We're all very fortunate to be in a great business and in a growing industry. And it all depends on your capital source. It all depends on if it's your money or you're raising money and what IRR you're working towards. But it's a great time to buy. I mean, it is. And though we've sold, we're still buying, and we still believe in the fundamentals of multifamily real estate. You just have to be really picky and smart, and you have to be the right operator. I mean, I will take the right operator, the right property manager over a specific property. You just really, really, really need to have the right team, the right people. Like Stuart said, it's people. We're in real estate, but our people are our most important assets. So you just have to have the right operators.
Yeah, I would agree. I mean, the fundamentals have never been better in the multifamily industry, and I think I think it really just takes patience and discipline and adjusting your return expectations. I mean, the days of hitting doubles and triples and home runs, I mean, those days are behind us. So, this is more of a long-term play. I think it's more of a marathon, not a sprint. And I think that if you're looking at downside risk more than upside in this market, I think you'll be well rewarded. I think there's still a very long runway in our business. I agree with that.
To stay on that, are you seeing any cracks in the market? Are you seeing deals going sideways? Especially Mike, because you guys do a lot of recaps. We were just talking about it before. When we did our first deal in 2012, I think you were putting out money at 13 and 3. Which, you'd be hung here if you were even put out that term sheet. So, are you seeing anything out there with guys in trouble, IO burning off, and maybe they actually have to start paying principal down? What are you seeing, and what do you foresee?
I mean, this clearly is the most historically long cycle we've ever been in. I mean, we're now 10 plus years into the cycle, and investors and sponsors seem to have 5-year memories. So, it's kind of a bit fuzzy looking back to 11 and 12. I think the stress that we're seeing is not in the fundamentals of the real estate itself. It's more in the capital structures. It's more with developers getting caught perhaps with construction delays or timing issues more than it is fundamentals. So the stuff we're seeing on the recap basis, or people that need short-term bridges, are more situational than anything. So I wouldn't characterize it as distress or cracks. I would say it's more timing necessitated and more leverage driven. So we are involved in a few recaps right now that are just really going to give our sponsors more time to correct a situational issue.
So one of the things that what I'm going to say is not going to probably be super popular in this room, but I know you like that, is that the number of inexperienced investors in the market has caused some issues. It's causing deals to fall out. It's causing pricing in some places to be compressed beyond what's reasonable. It's making me look much harder every time I sell at the true qualifications of the buyer, where their equity is coming from. The worst thing you can do in this business, and I'm on 40 years now, guys, is screw your reputation up by not closing deals, by tying up assets when you don't have the equity, by saying that you've underwritten things when it turns out you haven't underwritten things, and by retrading till, on items that are ridiculous. And when you do that, you're creating that we've ended up being the best second place runner I've ever worked for. Meaning, we didn't win the deal the first time, but we're almost always getting the deal the second time through. And usually for cheaper than the first person had it tied up, which tells you there's a little bit of a problem with the equity that's chasing the deals, and that's accelerated. In the last 6 to 9 months, I've seen more of that. The last 2 deals we've got, we were not the highest bidder. We didn't get the deal originally, and 90 days later, people are saying, "Hey, we need help here. We got to get out of this." So that for me is the crack I'm seeing.
So I guess I'm the bear on the panel. I do think there are some very interesting opportunities in multifamily, but overall, I kind of view what's been going on with interest rates as when interest rates go down, it's like everyone just gets really drunk. And they start doing things they would never do if rates were normal. So in 2007, everyone here has seen probably The Big Short. People were doing all sorts of crazy things back then. And in the last 6 months in particular, since they cut rates 3 times this year, and I think they're going to cut rates 3 times next year, I think we're going to go back to 0. People are doing all these things that they can only do if interest rates are this low. No matter what we think about the market, if rates were at, say, 6%, or we had a more normal rate, we wouldn't be even having these type of discussions right now. It'd be an entirely different discussion. So I think that a lot of people in Class A or in primary markets are going to have a very tough time. I mean, I know a lot of my employees rent in downtown Miami and downtown Fort Lauderdale, and they're getting 3 months free. And they're getting 3 months free with the concessions because they don't want to have to lower the market rents, and they can stuff the concessions below NOI or make them disappear, talking candidly. And that's not a sustainable business strategy. I mean, you need to have real cash flow. When you go through a downturn, it doesn't matter where your property is located. It doesn't matter how nice it is. It matters what your cash flow is. And maybe I'm like permanently branded as a receiver because in 2008 and 2009, I was a receiver going through this whole thing down here in South Florida. But I don't know, for me, my risk tolerance doesn't extend to kind of what a lot of other people are doing right now in the primary markets.
It's a very good point, right? There's renters by choice, and then there's renters by necessity, right? So if you think about the two different categories, my residents, for the most part, are renters by necessity, right? So if you just look at some of the numbers, 40% of Americans make less than $15 an hour, okay? 30% of middle income households, so between $40,000 and $75,000, can't afford an unexpected $400 expense. So when you just look at kind of what's going on, there's a huge need for B and C multifamily properties in tertiary markets throughout the country. And we as an industry have an awesome responsibility to provide housing to these people and give them a great living situation. So totally differentiating them, renter by need, renter by necessity.
Does this come into play when you're executing a value add or deciding if you want to put money into a property to upgrade it? How much does absolute rent? I know I always say that sometimes your tenant wants to just pay $1,200. They don't care if it's stainless steel, granite, whatever. They just want to pay $1,200. They don't want you to just keep ratcheting up the rent on it. So like, how much does that come into play where you look at it? Especially you see it in Class A, where let's say an apartment's $2,500 a month rent, but you can buy a house a couple blocks away, get a low rate on a mortgage. Like, you're going to lose a lot of tenants just to home ownership, or on the workforce housing side, you're losing tenants to to just unaffordability because you need to keep making your numbers work. So how much does that come into play when you guys are buying?
It's a great point. It's very philosophical, right? I mean, we have a huge responsibility to provide, just in this room, we provide housing to millions of people. Tens of millions of people, I'm sure. And there's a huge supply shortage of apartments in the country. And just looking at Roco's portfolio, we actually didn't execute on huge value add in units, but from 2018 to 2019, our rents increased 7%. So there's a big issue here. Rents are increasing significantly higher than wage increases. So a lot of these people, unfortunately, are getting priced out of apartments, and it's a huge issue that we need to address as a country.
So I just had another idea. I mean, we were talking about debt and how cheap it is. When you guys are buying deals, what do you prefer? Fannie, Freddie, CMBS? Like, what do you guys like going in, or bridge? Like, what do you like? I think it's good to also explain some of the nuances a little bit between, Fannie and Freddie are a little different, and with your business models, what do you guys like?
Is Rich Rodriguez not here? Good. Okay, I can say what I want. Because we won't talk. For us, we have been significant Fannie Mae borrowers since 2012. Continue to be. The certainty of execution is extremely important to us. We can't have deals, be retraded on us in the middle. Our quotes are very strong. We've established a really good relationship, not with just the DUS lenders, but have actually spent the time with the Fannie Mae people so that they believe that we're going to do what we say we're going to do. However,
because it's delegated to the
Right, to the-
originator,
right,
so
to the
they
originator.
can make the decision. But
Right.
if you want to go in for the bells and whistles, it's helpful to actually know the people calling the
right.
shots.
And as everybody, that model has unfortunately evolved, and for anybody who's done it recently, the delegation, and I'm using quotes, has sort of lost some of its luster in that they virtually have to go to Fannie Mae to get waivers for everything. So if they're having to ask for more IO, or you're having to ask for some kind of credit waiver or something, they can't make that decision anymore, where in the past they were making more of those decisions. I would say, though, the bridge business is really exploding. And I think that's because people feel that the whole play in the deal is the value add play. So you're going through that process. They're lending you a lot more money, right? They're lending you on cost versus LTV, and you're you're going through that process, and then you want to yank your equity out, or at least some of it out, and then maybe go to a permanent financing. I don't think I've ever had more bridge lenders call us and come after us for business, probably in 20 years, as I've had in the last 6 months. It's at least 5 a week. And they're new people I've never even heard of. I mean, people are popping up all over the place. So I think that's the way to financially engineer some of these deals to make them work, because long-term debt just doesn't work right out of the box.
I think at the end of the day, on the lending business, it comes down to relationships, particularly at this point in the cycle. So you talk about buy bridge lenders that you don't know their names, they come out of nowhere. When you and I met, Aaron, we started as a short-term bridge lender. We're still in the bridge business. I think you want to know if there is an issue, who you're going to pick up the phone and call and say, I have an issue, and this is the issue.
Because issues do come up when you own properties.
Pardon?
Well, issues do come up. It doesn't work like
Sometimes,
Excel,
yeah.
where just rent growth and everything is just moving up,
You got
right?
that.
I need more time, I need more of an
Right.
interest reserve. I mean, there's going to be those discussions, and you want to know who is there a person that you have a relationship with that you can pick up the phone, or is the loan securitized and it's tranched in
CLOs
17
and
different
it's gone. Yeah.
tranches where you don't know who to talk to if there's an issue?
Right. Yeah, I think the biggest mistake people do is, people get sold a rate. They're like, oh, I can get you a loan at 3.75. Okay, great. What does that mean? Is there a lockout? Who's behind it? Do they know how to service? If you need draws, is it going to, kill your ability to manage? So I agree. It's so important to actually know your lender, cultivate a real relationship, because when issues do arise, when you have a hurricane or a flood or a whatever, or shooting or whatever, things come up. It's important to have a real rapport with them and not just only buy, close on loans because it's the cheapest available.
Right.
So, I think just want to end off, and then we can just ask for some questions. Basically, I just want you guys to give advice for people that are maybe newer to the markets or just starting. Like, what's one mistake that you see that people miss, especially, or that they're not thinking of? I'll give you an example. Stuart and I sold a property recently, a portfolio in Ohio, and which was great. We did a great job. Stuart did a great job managing. We also bought it a long time ago, so that helps. But the tax bill in Ohio for sales tax, we had to write them a check for $1 million at closing. So I see pro formas all the time. They don't factor in sales tax. North Carolina is expensive. Texas doesn't have it, but that's a real thing that matters. It affects your bottom line. It affects your profits. It affects your promote. And it's something that's just a glaring mistake. Guys just don't realize it until you might get a big tax bill from a state. So what's something that you think that, with your guys' knowledge and experience?
My one recommendation would be to get to the properties. Don't just buy a property and hire either your own management company or a third party and think everyone's going to execute and the deal is going to make a lot of money. You have to be on site. You have to get to know your on-site team members, hear what are the issues directly from them, and get to know your residents hear from them and understand the issues. We have made our best decisions, our best strategic decisions as a business through talking to our on-site team members and talking to our residents. And it's very obvious at Roco that our corporate office only exists to service our on-site team members. So all the important decisions, everything important is made on-site, and we are just, at our corporate office, we're just there to assist. In addition, I stole this from a different company, but in every meeting we have at Roco, we leave an open chair, and that open chair represents a resident. Sitting in any meeting we have at our office, a resident's voice is in every decision we make at the corporate office. So it's very important. And you actually start to make better decisions when the resident has a voice at the table.
A couple of you have heard this from me today. Be annoying at the beginning when you're buying. Ask questions. Be in the broker's face. Ask, walk as much as you possibly can. Learn as much as you possibly can. Don't take, well, I can't get that for you as an answer. You know, spend the time. We are extremely annoying up front. But we have never retraded, and we've closed every deal we've ever had under contract since 2010. And the reason we do that is we spend the time up front. And that includes the physical side. You know, don't just accept, oh, we're going to get a tour. You know, do more than the basics, because there's always hidden things. And sometimes it's not on purpose. Sometimes it's just the way it is. And if you aren't annoying up front, if you're awarded the deal, it's going to be difficult, because now you're going to have to call up and say, boy, I didn't see that, or I didn't know about it, or the famous, statement, you didn't tell me about that. Well, that's not going to hold up, right? Yeah. So my advice would be, be a little bit problematic at the beginning so that you can find out everything you can. And when you're making your offer, and forget about whether it's hard money or not, but when you're making your offer, it's a real, you know a lot. You're very well versed on that property, that market, and everything about it. You can't, in this business, I don't think you can, half-heartedly go at anything. So that's my...
I'd say, focus on the downside in this market. I think your greatest asset in this market is your ability to say no. You don't have to do deals. It's nice to do deals. Everyone wants to do deals, but this is a market that maybe requires a little bit more patience than previous markets. So the greatest advice I give to myself in the morning is the ability to say no, the fact that you don't have to do anything, that you want to do deals, not because you have to do deals.
I would say, on top of what has already been said, is you want whoever your partner is going to be, whether it's a co-GP or your LP, is that you need someone that you can get into trouble with. And what I mean by that is it's really easy when things are going well and prices are going up and rents are going up and your rent goes up more than your expenses. But when you get into, and you will inevitably get into a problem, you want to make sure that you guys see things the same way and that you can figure it out together. Because ultimately, if you don't have the right partner, you're going to have a lot of other problems. That's one thing on the partnership. And the other thing I want to say economically is don't buy a property where they're building tons of properties nearby. That's just my opinion. It's not going to go well.
So I guess we can let's take some questions for them.
How do you deal with retrades when you're selling to unexperienced buyers or?
Stuart?
Me?
Yeah.
It was me. Well, since
Talked
I don't do it,
that,
I
yeah.
would expect other people not to do it. However, there are some legitimate reasons, for things to be retraded. What really turns me off is when it's only going to cost, let's say, $15,000 to fix the problem and they want a $150,000 retrade. At that point, I'm, okay, we have an issue. And I basically, it isn't that we say no, but we want to understand what they didn't see from the beginning. And we're willing to work with them. We're willing to be reasonable on both sides of it.
But it's like anything in life. You have to do your due diligence up front, right? You shouldn't pick a buyer if they can't close. You really, and HFF, JLL, does a very good job of interviewing the buyers beforehand and having them answer a whole questionnaire and understanding where their equity is coming from, understanding their debt source, understanding what they've closed recently. So just doing the heavy lifting up front to know that they will actually execute properly. And if they lie, they lie. You can't do anything about that, but do as much work up front as you can.
Yeah, I always, whenever people ask for proof of funds, you can send them a bank statement, but it doesn't mean you're going to give it to them. Like, so what? What does that mean?
Why is that right?
Reputation is probably the most important thing, as you guys mentioned. If you have a reputation for closing and you're going to close, then a bank statement showing proof of funds, everyone's putting a debt on these things, so it's irrelevant. So,
Just tell the broker when you sign the listing agreement that you're not going to handle any retrades. The broker handles it because it comes out of their commission.
If something that you come across, how do you deal with that?
Well, it happens all the time. And one of the things that we try to do is we try to tell our listing brokers they have to have seen the property or we won't accept an offer. Believe it or not, you could get 5 out of 10 people make an offer on a property, especially in the Carolinas for some reason, and those people have not even walked the deal yet. So those are not allowed. We just say forget it. We do ask, the broker questionnaire has become a very normal, originally I thought it was kind of hokey, when they first started doing that, probably 7 or 8 years ago. Now I think it's very valuable. It's helped us buy deals, get deals, but I think it's very valuable that, okay, what did you see? We want to know what you saw up front when you made your offer, and we go through it, and then sometimes they'll say, well, yeah, but we didn't, well, guess what? We asked you up front, you said this is how you underwrote your CapEx. That's not my problem. And, the one thing that I think is important in this market is the evaluation of the buyer. And it is really, you're expecting your listing broker, if you are selling through a brokerage, house, to do that work and figure out, hey, we've closed with this guy, we haven't closed with this guy. We know people this person has bought properties from, and believe it or not, people have called our references almost 100% of the time that we have been awarded deals. I used to think, okay, we'll just give them 6 or 8 names, everything will be fine. They're really calling the 6 or 8 names.
yeah, a lot of people I've seen also is access agreements to properties before tying it up in contract. So
we do that a lot.
It's open, and then that access agreement just rolls into a contract. So let's say you have a 30-day due diligence. You basically have 15-day access, and that will start the clock on your due diligence day 1. So that when you sign a contract day 15, you have 15 days more of it. So you're not tying a deal up in contract, and then everyone can just walk away. There's no harm, no foul. It's a little more of a fluid process. Banks, when you were buying REOs 2012, 2011, that's the way they always did when the special servicer sold it, and it seems to just be a very effective tactic.
How do you assess secondary, tertiary markets?
One of the most important lessons we learned, and Mike can probably tell you about our cycles down here in Florida, is something called sustainable jobs, not just jobs. Because you have looked at Fort Myers in 2008, 7. We thought the job market in Fort Myers was amazing. But 70% of the jobs were construction based. So when that stopped, there were no more jobs. And one industry, yeah, right. And one industry towns, we avoid. We spend more time on understanding, especially in tertiary markets, what's really fueling employment there. And a lot of our tertiary markets actually have major universities in them, which is a really good fail-safe for, for a recession. When there's a recession, more people go back to school, and universities don't typically lay off a lot of people. So when you have that going on, that's a kind of a really good fallback position. But places like, where there's one person, like Frigidaire or something, there's just no way. I mean, you'd have to look past that and see whether or not there are other employers.
I'd also add to that, not to fully focus on employment, although employment's important, but there's some small secondary and tertiary towns where you're getting a lot of retiring baby boomers, where there's not a lot of employment, where we've made investments in Concord, New Hampshire, places that, where people are actually retiring to. Not everybody can afford to retire to Florida, Arizona, or Texas. There are people in places like Concord and Rochester, and you can name 100 different towns where they're renters by need, not renters by choice, that they're not moving to the warm weather climates. So there are some great secondary and tertiary markets around the country that aren't big employment drivers, but they are high quality places to live.
All right. Thanks a lot, guys.